Hi there, welcome to Kneppy Invests. About a month ago, I did receive a suggestion from a viewer of this channel into looking at a company called Big River Industries. I had a close look at not what the company does, but just the valuation. And at that point in time, this company became a little bit intriguing to me because on the surface, Big River Industries looked good value. So I thought I'd do a little bit more exploration into the company and actually did promise that I would do a video on this company. This particular viewer asked me the question again, where is the video on Big River Industries? Hence, persistence does pay off because here is the video in regards to this company. Now, the agenda for today's video is I'll have a quick look at what the company does, which is always important. Then I'll have a look at the valuation and the reason why I initially became intrigued in this company. And it does lead to a question. Is this company good value or is it a value trap? And that is a very important question to ask because if it's good value, now could be a really good time to take a position in this company. Or on the flip side, if it's a value trap, share price could fall significantly further from here. Then I'll take a look at the quality of this company. And this is another fairly important question because if I do come away and decide that this is a high quality company, even if it's maybe a slight value trap, I probably would be more inclined to take a position, particularly if I think this company will significantly grow in the next 5 to 10 years. And I would actually think it's going to grow in the next 5 to 10 years if I do think it is a quality company. So I'll talk about the quality and what I think the quality of this company is during this video. We'll also have a look at the financial history. So this company listed on the ASX in April 2017. So we have about 9 years of financial history. So I'll look at the revenue history, profit, and also operating cash flow. And I'll also have a look at this company's half year results. You do get a good sense around this company just by looking at the half year results. And when I say good sense, I'm talking about the quality and whether this company has any purchasing power or any pricing power. And then at the end, excuse me, and then at the end of the video, we'll have a look at the company's chart. And the funny thing about a chart is if you look at a long-term chart of a company, you get a pretty good sense around the quality of that company. Even though quality can be considered a fairly subjective thing, it becomes less subjective when you look at a chart and just have a look at a high quality chart of a high quality company. Have a look at the chart of CSL over a 20-year period, or maybe even Microsoft over a 20-year period. You'll see the same sort of signatures when you talk about high quality companies versus low quality companies, particularly low quality cyclical companies. Now onto what Big River Industries do. And before I did a bit of research on this company, before I received this question, this suggestion from a viewer, I actually had no idea what this company does. So they are a manufacturer and distributor of timber and building products, primarily in Australia. However, they do have a little bit of business in New Zealand. In fact, 92% of the company's revenue is derived in Australia, 8% in New Zealand. So this company is definitely local, not global. So they manufacture softwood and hardwood form ply and structural plywood products. They are a seller of consumable formwork products, and they're also a merchant of timber and associated building products to local trade and medium-sized and enterprise-sized companies. If you look at a breakdown of their revenue by region, and when I say region, I'm talking about states plus New Zealand. Some might say New Zealand is an Australian state. Eyes rolling there. 26% of the revenue is derived in Queensland and Victoria, 23% in New South Wales and ACT. And when you break down their revenue by construction market, 40% detached housing, 23% commercial, 17% multi-residential. So again, this company is fairly similar to some of those other building type companies like James Hardie, CSR, Boral, Brickworks. However, this company is significantly smaller. In fact, the market cap of this company, last time I looked, was about $120 million. So the first thing I did when I did receive this request, this suggestion to look a little bit more into Big River Industries, first thing I did is had a look at the valuation. Yes, even before I had a look at what the company does, even before I had a look at their financial history, I just wanted to see the valuation of this company. So I looked at PE ratio, looked at price to book ratio, looked at EV to operating cash flow, not just now, but the history it has over the past, well, since it listed back in 2017. Now, I'm not going to show you the PE ratio, but what I'm going to show you here in this particular slide is the price to book and EV to operating cash flow history of Big River Industries since they listed. And the thing that struck me when I looked at these particular valuation metrics right now is how they are at historical lows. So, in fact, the price to book ratio, which is in the orange, and the EV, the operating cash flow, which is in the blue, have never been lower for this company. Now, I believe when you do look at the valuation of a company, no matter what metric it is, P ratio, you can't just look at the number right now and decide whether a company is cheap or not. In fact, for some companies, particularly mining companies, you shouldn't be even be looking at the P ratio because it can be deceiving looking at the P ratio for mining companies. So you need to know what context you are talking about when you are discussing the P ratio. And I do like to look at the historical range a company has, particularly for non-mining companies. So right now, the price to book ratio of Big River Industries is around 1. So we know the market cap is 120 million. So we already know that the equity of this company or net assets of this company is about 120 million. Now, historically, the price to book ratio of this company is above 1. In fact, most of the time, it's above 1.5. Only once since it's been listed has the P ratio or PB ratio of this company been below 1 apart from now. And that was back in 2019. It only stayed below 1 for a fairly short period of time. So we're talking about 5 to 6 months or so. So right now, the price to book ratio of Big River Industries is at the low end. It's in the bottom end of historical ranges. So straight away, that is suggesting to me that this company might be good value. Now onto the EV to operating cash flow. One of my favorite valuation metrics, I do prefer EV to free cash flow, but in this case, I'm looking at or discussing EV to operating cash flow. And through its history, the EV to operating cash flow has been falling. So this could be concerning. This could be an indication that the market has a very low expectations, very, very low expectations for this company moving forward. Because right now, the EV to operating cash flow of this company is 4.2. It has never been low. So again, I think that could be suggesting that the market expects the earnings or the operating cash flow of this company to significantly drop in the next few years, if not in the next current financial year. And if it doesn't, again, this company is good value. But the market could be right. And right now, the company's profits or operating cash flow or free cash flow would drop significantly in this financial year. And that would be a justification for why some of these valuation metrics are quite low. In particular, the EV to operating cash flow, EV to free cash flow as well. And that's probably the main thing you have to figure out for yourself. Is this company really good value right now, or is it the value trap? I think the market is suggesting to us that this company is a value trap right now. The market is saying that the profits and operating cash flow, free cash flow will fall significantly in the current financial year. Because if it doesn't, then this company is extremely good value at current prices. Now onto the quality. And quality matters because if I came to the realization that this company was really good quality, I probably wouldn't care all that much on that question whether the company was good value or the value trap. Because typically, a quality company, a high quality company, would very rarely be a value trap, if at all. So let's have a look at the return on equity and return on capital employed history of this company since they listed on the ASX. So what I'm looking for here is numbers above 10%. So again, you can't look at return on equity, return on invested capital, or return on capital employed just right now. You have to look at the historical ranges of the company. And I like to see the return on equity and return on capital employed or return on invested capital to be above 10 throughout most of its history. So let's have a look and focus on return on equity. From when it listed on the ASX through to 2021, return on equity of this company was below 10, as low as 4.2% in 2016, 6.4% in 2019, and 6.7% in 2020. But it seems like something positive happened to this company in 2022 and 2023, because not only did this company see its return on equity absolutely explode from 2.2% in 2021 up to 20% in 2022 and almost 20% in 2023. So more than likely, this company was experiencing some pretty significant tailwinds back in those years. So we're talking about being able to sell their products at pretty good prices, lesser competition, increased margins because of all that sort of thing. And that really helped their return on equity. So more than likely, the equity didn't increase all that much, but the earnings, their profit exploded those 2 years, more likely because of margins. But you'll notice, over the past few years, return on equity and return on capital employed are starting to decrease. That's one thing I don't like to see. And I will probably argue there is a high, we'll say medium to high probability the return on equity of this company will fall below 10% within the next few years, because instead of significant tailwinds behind the company is going to see and continue to see headwinds that they are experiencing right now. And I'll talk about those headwinds later in the video. One of the first things I look at when I'm researching a company is financial history, particularly focusing on revenue. And then if I like what I see when it comes to revenue history, I then go down to gross profits, look at gross margins, look at income, and then I'll delve a little bit deeper after that, looking at cash flow, that sort of thing. But the first thing I want to do, always want to see, is revenue increasing through time. And this is a breakdown of Big River Industries revenue, gross profit, and net income in half-yearly increments since they listed on the ASX. Now, revenue is in the blue, gross profit is in the orange, and net income or profit is in the purple. So the first thing that stands out is that profit has been increasing through time, particularly between 2020 and 2022. Remember, that was a sweet period for this company. In fact, revenue grew significantly during that period. But you also noticed that in the last 4 half years, revenue has flattened out. It's going sideways. It's struggling to grow. But added to the struggle in growth in revenue, this company is starting to see their gross profits falling. It's fallen from 64.3 million in the December quarter or December half 2022 down to 57.8 million. But more troubling is a decrease in profit. Now, if we go back to pre-COVID years, this company had trouble generating much profits. In fact, profits were about $2 million every half year up until 2021. So no growth in profits through that period, even though revenue was slowly climbing. That is telling me that the company's margins were actually decreasing during that period. And then during that sweet period, profits absolutely exploded up to $12.4 million in the half year to June 2022, $12.9 million in the December half year. But profits have almost halved since then, down to $7.1 million in the most recent half year. So not only is revenue starting to drop, we're also starting to see a significant drop in profit. That is telling us that the margins in this company are being absolutely suppressed. And I'll discuss that later in the video as well. And that is also a sign that the company may not be high quality because they have having trouble maintaining their margins at previous levels. So let's take a look at their financial statements that they did reveal to us in February, the half-year results. So a few things. I'm going to look at the profit and loss statement, then the balance sheet, and then the cash flow statement. And I'll just point out some interesting things here. Now, one of the most interesting things about the profit and loss statement, we'll talk about the highlights in a second, is when you go down the profit and loss statement, you see exactly the opposite to actually what you want to see. So everything is down. But as you go down the list, everything is going down by a greater percentage. That's not what you want to see. And that is a pretty negative indication of how the company is performing, particularly around their margins. The margins are really being suppressed. I think I already used that word. But revenue down 5.9%. And just keep these numbers in mind and just think of the trend in each of these numbers. They're going up. The negative decrease is going up. So revenue down 5.9%, gross profit down 10.1%, EBITDA down 28.3%, EBIT down 39.5%, and profit, I'm going to skip past profit before tax and net profit after tax before significant items. I'll go straight to net profit to equity owners, down 44.8%, but net profit before significant items down 47.3%. So again, revenue down 6%, profit before significant items down 47%. And profits before significant items actually fell from 13.1 million to 6.9 million. That is suggesting to us that this company is being margin squeezed. And they actually do highlight this or mention this in the highlight section. So why is revenue down? Revenue down driven by lower residential activity, impact of continued labor shortages, and site delays. Now, some of that might be short term. We don't know about residential activity. Maybe that's going to pick up soon. Who knows? I have no idea. But let's have a look at the gross margins. So gross margin down 130 basis points. Now, I love gross margins because gross margins do give us an indication on the quality of the company, particularly when it comes to pricing power. And many high quality companies, maybe the majority of high quality companies, have pricing power. So here is an indication of why this company may not be high quality. Probably is not high quality. So gross margins down 130 basis points versus the first half financial year 23. This key driver was reduced by frame and truss volumes, and this is the most important bit, and increased competitive pressures. Hence, decrease in margins because increased competitive pressures. They can't put up the prices as much as they want. So some of the supply costs might be increasing, but they can't increase their prices because of these competitive pressures. Now, that sort of makes sense. I would imagine in this sort of sector that name means something. So if this company's products were of high quality and they had brand or name recognition, they might be able to put up their prices. Sort of like Coca-Cola, Pepsi. They're just able to put up the prices no matter what, and people are still going to buy their products. They probably don't care how much the products cost. So this company probably doesn't have that name recognition, and they just can't put up their prices because of these competitive pressures. And that's probably what I'm going to talk about when it comes to profit and loss statement. So let's move on to the balance sheet. Now let's have a look at the company's balance sheet. Now I'll just go through some of the things I look at whenever I am viewing a balance sheet. Now in the highlights section, I do slightly disagree with their first point. They actually do say this is a strong balance sheet. Don't necessarily agree with that because of their debt. $43.3 million of debt. I would prefer that to be a little bit lower for a company with a market cap of $120 million. But someone would probably argue, if you look at the debt to equity, it's not that high. It's probably about 35%, if that, which is not necessarily too high. But for this size company, I do prefer a company to have as minimal debt as possible. Now, some of the other things I look at, cash and the trending cash. So cash has gone down to 24.3 million. So that might be a little bit of a red flag that cash is dropping. Also look at changes in working capital. And they do mention, you could sort of figure this out yourself, but they do mention here, strong financial disciplines resulted in 17.2% reduction in net working. Did they leave out a word there? I think it should be net working capital as compared to the previous corresponding period. So net working capital or working capital is just net assets minus net liabilities. I think net assets, you also have to take away the cash. So we're talking about trade and other receivables, inventories on the net asset side, and mostly trade and other payables on the net debt side or net liabilities side. Net assets or equity is 120.5 million, down slightly from last year. And intangibles, 59.8 million. Always have a look at intangibles. I do prefer to look at the net tangible assets of a company. And when you do that, you get net tangible assets of 60 million, just above $60 million. And I do prefer, instead of price to book, I actually do prefer price to net tangible assets. And if you do prefer that, you get price to net tangible assets of 2, not, well, a little bit higher than the price to book of 1. So I do prefer price to net tangible assets over price to book, because intangibles, what is that exactly for this company? Now, a lot of times when a company makes an acquisition, they pay a premium, and that premium, or the price of that premium, is put into intangibles. And when a company has a bad year and they need to do some write-offs, the accountants go in and say, well, I'm not sure about these intangibles. You will see a lot of companies write off their intangibles. And a lot of times it's just a 1-year write-off, and a lot of companies will see their intangible drop because of these write-offs, particularly if a company has had a bad year. So not the biggest fan of intangibles, because I'm not even sure what it's measuring, but I do prefer net tangible assets. And for this company, it's about $60 million. Now onto the cash flow statement. And yes, they did leave out a word in the previous slide, because I actually do mention here 17.2% reduction in working capital as compared to 31st December 2022. So I'm pretty sure that's almost the exact same. Well, they, instead of previous corresponding period, they used 31st December 2022. Not sure why they just didn't copy and paste. It would have been simple. Although if they copied and paste, they might have left out the word capital in this highlight session. Anyway, I'm going on a bit of a tangent. So I do like the cash flow statement. I do like cash flow, operating cash flow, free cash flow. But sometimes a company can legally manipulate these numbers to make it higher or lower than it probably should be, particularly when it comes to changes in working capital. So if a company increases the inventory or significantly increases the inventory, maybe they're expecting some really good growth, sales growth, you will see a significant hit to the operating cash flow and free cash flow of the company, which makes sense. They're putting all their money into inventory. And on the flip side, when a company decides to sell all their inventory, you see a significant decrease in inventory, and that can have a significant positive impact on operating and free cash flow. A lot of times you will see a company mention in the notes any changes in working capital, but we already know, if you look at the balance sheet, inventories didn't change, and trade receivables and trade payables were down about 10 or 11 million dollars, and that will have an effect on operating cash flow and free cash flow. So let's have a look and go down this particular cash flow statement just to see if there's any red flags here and why actually cash fell by $10 million. We do discover that little fact in this particular financial statement. So operating cash flow, $19.6 million. Now, they did pay $8.5 million in income tax. And I saw that and I went, that's really high for this company. But they did mention in the highlight section that there was a higher tax payment in the first half, which includes a payment of tax liability relating to financial year 23. So I probably would suggest that is probably a one-off, and any income tax paid moving forward would be a little bit lower. So that did have a negative impact on the free cash flow and the cash generated from operating activities. Also, interest paid, $1.7 million. Not as high as I thought it might have been, because they have $44 million of debt. So the interest rates they're paying on the debt isn't that high. And also capital expenditure. So for those who want to know how you calculate free cash flow, looking at the cash flow statement, because I don't mention free cash flow here, you just take the cash from operating activities minus the capital expenditure. Sometimes it will be spelled out as property, plant, and equipment. But here, they've called it straight out, capital expenditure. I would assume in the proper financial statement, it's actually written as property, plant, and equipment. So the free cash flow of this company in this half year was $8.2 million. Now, lease payments, 5.3. Now, they did make some accounting changes a few years ago. Hey, it's quite a few years ago. So lease payments, in my opinion, are more of an operating cost. That's just my opinion. And this is really true for retail companies, particularly companies who have brick and mortar stores. You're paying a lease. You can't operate without paying a lease unless you own the store outright. And that, in my opinion, that just belongs in the operating section. But this company paid $5.3 million of leases in this particular half year, which would mean this company was free cash flow positive by was about $3 or so million, and then the company paid a $7 million dividend. So now we are seeing the reasons why the company's cash did fall during this half year from the previous corresponding period. Now into the chart for the company. And I've already mentioned that sometimes you can determine the quality of a company just by looking at the long-term chart. So this is the weekly chart for the company going back to when they listed. And this is not the sort of chart you would find with a high quality company, particularly over a 7-year period. In fact, the share price right now is just around the share price when it listed. So it listed around about $1.50. Now the share price at the end of trading on June the 10/98, June the 7th, was around $1.50. So almost identical share price from when it's listed. That's not really what you want to see in a high quality company, or what you would expect in a high quality company is probably the better way to put it. Now, the company has gone through periods when it's beloved by the market, particularly in 2021 through to probably the start of 2023. And remember, that was a sweet spot, sweet period for this company. In fact, the share price went from about or below $1 in 2019 to a high of almost $3 start of 2023. But it seems like those tailwinds are coming to an end, or not seems like it, those tailwinds have come to an end, and this company is now facing some headwinds, increased competitive pressures, stuff like that, lower, what was it, construction activity, stuff like that. So share price has taken a bit of a hit, has fallen about 50%. It's gone from about $3 almost 1 year ago down to $1.50. Now, one thing I did notice when I had a look at this chart is the increase in liquidity over the past few years. This company was quite highly illiquid back in 2019, even into 2020. So the liquidity of this company has improved over the past few years. But the share price right now is in a well-defined downward trend. Now, because I wouldn't consider this company to be high quality, the chart matters. And the only way I would take a position in this company right now is if I saw a shift in sentiment and a shift in trend in the share price. But if you determine this company would be a high quality company in the future, and I think this company is really good value right now, maybe even at a share price of $1.50, this is a good time to take a position in this company. So it all depends on how you research this company and your opinions on this company. And we're all different. I may not necessarily take a position in this company, but potentially for you, this is a great time to enter this company, all depending on what you think about Big River Industries. And that is all I have for this video looking at Big River Industries. I'd love to hear your opinion on this company, so leave those in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.